All right, hello everyone. Just want to take a quick look here at SPY so we can kind of get an idea of what to watch next week. Personally, I think the market's going to go lower. I mean, I don't understand how we've been shaking off this sell off and this breakdown in the financial sector, but I think what's going on is we got this kind of flight to safety, right? If we look at, say, the technology sector, it's dominated by Microsoft and Apple. In other words, it's a market weighted sector. Every stock is not equal in just say hypothetically the S&P 500 technology sector. Microsoft and Apple are almost half that sector, and there's 500 stocks. So people could be selling the vast majority of stocks because they're afraid, and that money is going into these perceived as safe stocks. Hence, Microsoft and Apple. The same thing happened at the end of 2021, and it was right before we had a huge sell. Now, I'm not saying we're going to have a sell-off like that, but it's just important to remember because of the index construction, things can mask weakness. Here we're looking at the S&P 500 ETF, SPY, aptly named because the symbol is SPY. This is 500 stocks. Apple and Microsoft together are 13%. That's more than 1/8. So if people are selling a lot of different stocks and they're just putting their money into Apple or Microsoft because they think it's safe, once that flow into safety or that flight to safety is over, things could just unravel. And I think there's a lot of things that support that. But tonight I'm just going to go over the S&P. If you want to check back tomorrow, I'll do a more detailed analysis. I got to do my other job tonight, meaning like, deal with my wife and kids, blah, blah, blah. All right, everyone. All right, fellas, everyone out there who's married understands what I'm saying. Now let's just take a look here. This chart teaches us some important lessons. There's been support around 405. There's resistance around 416. When a market's moving higher, there's not enough supply to fill all the demand. The buyers have to be willing to pay a premium to get sellers off of the sideline. When we get resistance, well, there's enough supply to fill all the demand. There's a lot of investors who want to sell. When we get to support, it's the opposite. If the market's going lower, it's because there's not enough demand to absorb all of the supply or not enough buy orders to take in all of the sell orders. So the market goes lower because the sellers are forced to offer their shares at a discount. The vast majority of trading moves are because of just psychology and supply and demand. It has nothing to do with what they're saying on CNBC or Fox Business News or whatever chat room you might be in. I tell my students, just shut off the media, just pay attention to the charts. You can learn how to think for yourself. Within a few months, the market will not appear nearly as mysterious as you think it is. Anyway, we're going higher. We get down here, and lo and behold, what happens? A support level becomes a resistance level. How could this happen? Remember, a support level is a level where there's a lot of buy interest. A resistance level is a level where there's a lot of sell interest. At these levels, at support, there's more demand than supply, and at resistance, there's more supply than demand. So what happens is the market goes lower. A lot of the people who bought here, oh, you guys hear those birds on my back deck? So nice, man. I love the birds. So there's a lot of people who bought here at support, and when the market goes lower, a lot of these investors say, man, I made a mistake. I shouldn't have done that. I'm going to sell, but I'm only going to sell if I can get out of break even. So when the price goes up to their level, we have these remorseful buyers placing sell orders. The level that was support converts into resistance. You can see this on a lot of different charts. It's a market principle, and this is what we teach at stockmarketjobber.com. The market has these principles, and if you pay attention to these principles, the market will tell you what to do. Let me repeat. Let the market tell you what to do. Come in every day with an agnostic opinion. Let the market tell you what to do. If you have a preconceived notion, it could alter your thinking. You might be subject to confirmation bias, other biases, and we also have a lesson on investment psychology. But anyway, let's go back to this. So we have a lot of supply. Market goes lower. Get up here. Now look at this. Resistance has somehow become support. How could this seemingly happen? Well, obviously it happened. It's seemingly amazing. How could resistance become support? Well, we have a lot of people who sold who, once the price goes higher, they regret selling and they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can buy them for the same price that I sold them at. So we have remorseful sellers placing buy orders at the level that was resistance. So buyer's remorse can turn support into resistance. Seller's remorse can turn resistance into support. It's just a fact about financial markets that some price levels are more important than others. Believe me, I spent 20 some odd years in the institutional trading world. I hate to date myself. When I first started, things like ETFs didn't even exist. But over those 25 or so years, I've learned some simple principles. There was a time where I knew everything. I read every book I could. I studied Gann theory. I studied Elliott Wave. I went to every conference. I got the CMT. Let me tell you, let my 20 years of experience benefit you. It really just comes down to keeping it simple. Some price levels are more important than others. When you get to resistance, there's more supply than demand. When you get to support, there's more demand than supply. Levels that were support can become resistance because of buyer's remorse. Levels that were resistance can become levels that were support can become resistance because of buyer's remorse. Levels that were resistance can become support because of seller's remorse. It's just market psychology. We're not looking at astrology here, okay? We're looking at, if you look at a chart the right way, it's a graphical illustration of investment psychology and supply and demand. That's what it is. Unfortunately, most technical analysts suck and they give the profession or the discipline a bad name. All right, enough of me bitching. Now, why would a resistance level become resistance again? Investment psychology. There are people who bought up here. Once the price goes lower, they regret doing so. They tell themselves if it gets back to their level, they're going to sell to try to get out. So you have remorseful buyers placing sellers. This is not support turning into resistance. This is resistance staying intact. Why else would there be resistance at a former peak? Just think about it. I don't know if you're in business school or whatever, if you're a fundamental analyst, you can't explain this. But if you're a person who follows what we do at Stock Market Jobber, which is market equilibrium analysis, this is a simple thing to understand. Why would support remain intact? And of course, this is short term, but the same applies over a long time. Well, there are buyers who wanted to buy who, when the stock got away, or the ETF got away, they said, you know what, big deal. I'm just going to be patient and hold on. There are people that went short who are losing money when the market goes higher, and they tell themselves, I'm going to buy my shares back if I can get out at break even. So you have remorseful short sellers placing buy orders. Pretty clear, you don't need to be a market guru or a former hedge fund trader. Everyone talks about these former hedge fund traders. Guess what? I was a former hedge fund trader. I probably oversaw the trading of 12 or 15 different hedge funds. It's really not that big of a deal. I mean, it gives you a lot of knowledge about the market, but the only difference between, say, a hedge fund and a mutual fund is really just the fee structure. So if you check out our market lessons, there's something on there about me explaining what hedge funds really are. Now, before I get going, I just want to point out, this week, let's look for resistance at 416. Let's look for support at 405. We get to 416, there's a good chance we get a little bit of a sell-off. We get back to 405, there's a good chance we get a little bit of a bounce. Now, before I go, I just want to point out something that is a concept that it's a little more advanced, but you are going to be very happy if you understand it. We talked about how support can become resistance because of buyer's remorse. We talked about how resistance can become support because of seller's remorse. Notice this phenomena of we get a really fast move up, we get a really fast move lower. We get a really fast move up, we get a really fast move lower. How does this happen, or why does this happen? Well, when something blows through these levels really quickly, for example here, which is ripped higher, what's one of the reasons why we have support? Remorseful sellers trying to buy their shares back. When you rip through these levels so quickly, there's just not a lot of time for there to be a lot of sellers who form this vested interest. So when the sellers come in, there's not going to be these remorseful buyers trying to buy their shares back. So the sellers are going to have to sell at a discount. And this forces a rapid downtrend. Here we have the same concept. Fast move higher, fast move lower. There are sellers, but the move through these levels so quickly that there just wasn't a lot of time for there to be this large concentration of remorseful sellers trying to buy their shares back. So when the sellers finally come in, there's no buyers out there. There's a lack of buyers. They got to knock the price down. Now, how about this? Fast move down, fast move up. This is the opposite. Remember that buyer's remorse turn support into resistance. When you make a move this fast, there's just not a lot of time or enough time for there to be a lot of buyers to build up this vested interest. And when the market starts to move higher, the buyers just have to come in and be like, wow, where are those remorseful buyers that are willing to dump their shares? Guess what? They're either not there or there's a low amount of them. The buyers are forced to pay higher prices, much higher prices. This drives the uptrend. So remember, resistance becomes support because of seller's remorse. Support becomes resistance because of buyer's remorse. Levels that a market blasts through quickly can reverse really quickly back through those levels when we're coming the other way. We see it here, right? Big move down here, just wasn't a lot of time for there to be a lot of buyers to buy that are now remorseful. Big move down, big move up, big move down, and now we have a big move up. How does this help you? Well, if something is really getting crushed and goes down really fast and ends up at a support level and it's oversold, it reverses. There's a good chance it could move up really fast. All else being equal, you're better off jumping into that position than the market that moved slowly down to support and held, because it moved slowly down to support and the price levels above where the support is. There is going to be a lot of buyers who bought who want to get out. So you're going to have this vested interest of people that want to sell. So just remember, fast move up, fast move down, fast move down, fast move up. Levels that were resistance can remain resistance for a while because of buyer's remorse. Levels that were support can become resistance because of buyer's remorse. Levels that were support can stay intact because we have people that wish they bought. Maybe they were short sellers. They missed getting out at break even. Or we have buyers who are patient. So levels that are support can remain support. It's called market memory. Listen, everyone, please sign up for my website. I mean, I'm really dedicated to helping people at this point in my career. I want to give something back. I spent 20 some odd years in the institutional trading world. I literally worked with some of the best traders and money managers in history. I worked with Stephen Cohen. I worked with Mary Gabelli. I know enough about the market to make sure I'm not too overconfident. But what I am confident about is that I can teach you the techniques that could make you successful. Just like a guitar teacher can give lessons to a guitar player, well, they maybe not end up being Jimi Hendrix or Jerry Garcia, but they're going to get better and they're going to get competent. And competent guitar players can make money. You don't need to be the greatest trader in the world. If you're a competent trader, you can make money. All right, everybody, thank you so much, and I will see you soon. Have a nice weekend.